We'll still have about 5 minutes before we actually go live.
Okay.
All right. Ready, ladies and gentlemen, we'll be getting started in just a few minutes. Hey Ben, I'm getting a little bit of feedback on. Do you have a mic that you're wearing?
I do not. No.
Looks like it stopped now. It kind of sounded like almost as if someone was kind of bopping their hand on top of the mic.
Yeah, that would be. I'm assuming that's my youngest daughter, who's directly above me, doing what.
Oh no, no worries. No
Sounds
worries.
like maybe some sort of tumbling gymnastic routine.
No worries. We can't control that. Just want to make sure it wasn't an audio issue.
No.
Alrighty. Well, ladies and gentlemen, we'll be getting started in 2 minutes. We really appreciate you joining us this afternoon. The ins and outs of investing with ETFs is coming up next from Ben Johnson, Director of Global ETF Research at Morningstar. We'll be getting started in 2 minutes. Alrighty. Ben, can you hear us okay?
Loud and clear.
Excellent. Well, I'm delighted to welcome our next presenter to the stage. Ben Johnson, CFA, is the Director of Global ETFs Research and editor of Morningstar, ETF Investor, a monthly investment newsletter. Before assuming his current role, he was Director of ETF Research for Europe and Asia. Mr. Johnson also previously served as a senior equity analyst covering the agriculture and chemicals industries. And before joining Morningstar in 2006, he worked as a financial advisor for Morgan Stanley. Ben, it's a pleasure to welcome you. The stage is yours.
Jordan, thank you so much. And thank you to everyone in the audience for spending time with me today. We've got precious little of it, so I'm going to dive right in and talk a little bit about the ins and outs of investing with ETFs. Specifically, what I want to talk about is the what, the why, and some of the how of ETFs. First, by defining ETFs, defining them figuratively, defining them relatively, defining them in the negative, to help you understand really what are ETFs, very fundamentally. To talk a little bit about why investors might choose to use ETFs over other means of accessing diversified investment portfolios. I'll finish by landing on a few of our favorites, and hopefully we'll have a few minutes at the end during which I can field some questions from you all. I'm eager to hear from you. So let's get into it. What is an ETF? And defining ETFs figuratively at first, what I would argue is that ETFs, first and foremost, are an advancement in investment technology. No different than we've gone from landlines to mobile phones. We're now all walking around each and every day with what is effectively a supercomputer in our pockets. ETFs represent an advancement in the way that investment strategies are packaged and then ultimately delivered to the end investor. And like any good advancement in technology, they do things better. They do it faster, they do it more cheaply. They have new features, new benefits that weren't something that you would get out of the prior technology. So ETFs, I would argue, are to mutual funds what your Apple iPhone 12 would be to an old rotary landline telephone. They're better, they're more powerful, they deliver certain efficiencies, meaningful, measurable benefits to you as an investor. And to dig into this a little bit more, what I would say is that this advancement in technology is really predicated on advancements in technology, literally, more broadly. ETFs are really simultaneously a product and a poster child of the information age. If you think of just the raw computing horsepower that's needed to support the ETF ecosystem, so real-time calculations of index values, real-time trading of individual securities that used to take place with quotes being in fractions. You don't see 7/8 next to any prices and ticker symbols in the Wall Street Journal these days. All of this information moving around in real time around the world as smoothly, as efficiently as possible is really necessary. It's the foundation for a healthy and vibrant ETF ecosystem, these baskets of stocks and bonds that are traded in real time, sometimes millions of times, each and every day, each and every millisecond. I would also argue that ETF's success is really in many ways reflective of other global trends towards greater transparency, lower costs, and disintermediation, the cutting out of middlemen that have existed, that have taken a rent for their services for a long period of time. ETFs cut out a lot of the middlemen. They deliver something directly to the investors. So to use another analogy, ETFs are really kind of the Amazon Kindle to mutual funds local bookseller. Now, I would argue one of the key benefits of ETFs, where many of their advantages are rooted, has everything to do with the way that money comes into and goes out of an ETF versus how money is traditionally gone into and out of an open-ended mutual fund. Now, many of you are probably very familiar with the way that mutual fund creation and redemption works. When you want to invest in a mutual fund, you as the investor fork cash over to the fund company. The fund company turns around and hands that cash to the portfolio manager, and the portfolio manager puts the money to work in the capital markets. adding new positions to the portfolio, adding to existing positions, you name it. Now that process works in reverse. When you want your money back, when you go to redeem your investment, the mutual fund company gets your redemption request. They turn around again to the portfolio manager and say, hey, we don't have enough cash right now in our coffers. We need to raise more cash to meet these investors' redemption requests. Can you go out into the market and can you sell some of the positions in your portfolio so that we can hand it back over to the investors that you've been serving? Now, what happens in these transactions is that there are any number of different frictions. There's commissions, there's market impact cost, and most notably, and most recently, what we've seen is that there is significant friction that's experienced at the individual investor level, especially if you're investing taxable money, in the form of tax costs. We've seen massive redemptions across a whole host of open-ended mutual funds in recent years, and this has happened in the midst of a prolonged bull market, which has forced many funds to realize taxable capital gains, which they in turn have to turn around and distribute to open-ended mutual fund shareholders. These frictions are the reality of the cash in and cash out proposition that is an open-ended mutual fund. Now, how ETFs are different has everything to do, again, with the way that money and securities move into and out of the portfolio. So when you and I are buying ETF shares, we're trading them back and forth on the stock exchange, no different than we would shares of, say, Apple or Amazon or Walmart. ETF shares are just bundles of the securities, the stocks, the bonds that exist in an ETF's portfolio that are trading back and forth in real time on the stock exchange each and every day during normal market hours. Now, when supply and demand gets out of whack, when more people want to take their money out of an ETF than are putting it in, and vice versa, what this creates is brief imbalances in supply and demand for those ETFs shares. And what that manifests in is small and typically fleeting premiums and discounts of ETFs prices relative to the value of their underlying assets. Now, these premiums and discounts send a signal to the marketplace, specifically to a special breed of market makers known as authorized participants, to step in and right this issue. They can profit from this issue in cases where ETFs are trading cheap relative to their net asset value by buying up those securities or buying up those ETF shares and returning them to the ETF company in exchange for the underlying securities, and then selling those securities relatively dear, and vice versa. Now, what this means, because ETFs, unlike mutual funds, are a securities in, securities out proposition, they create and redeem on an in-kind basis, is that there's little, if any, actual buying and selling of the underlying stocks or bonds that's taking place. And investors aren't faced with any of those frictions that are otherwise created by the coming and going of fund investors around them that might be either redeeming or creating, and all the while creating these externalities, these frictional costs that are socialized across all fund investors. Now, ETFs are a pay-as-you-go proposition. You pay a bid-ask spread when you buy or sell ETF shares. You pay taxable capital gains as you realize them, as you buy or sell. Now, that's not to say that there aren't periodic taxable capital gains distributions from certain ETFs. It's just they tend to be fewer, much further between, and much smaller in magnitude than anything we've seen, certainly recently, among open-ended mutual funds. So to use this analogy, what I would say is that ETFs really turn the inner workings of the way that money comes and goes, securities come and go from the portfolio inside out. So some of you may recognize this, others may not. This is a picture of the facade of the Pompidou Museum in Paris. And what the architect did was it took all the guts of the building, including one of the main staircases, and basically pasted them on the exterior of the building. So all the HVAC, all the plumbing, staircases, you name it, are on the outside of the building, and what is left inside is a very clean, frictionless environment. It's just a bunch of blank walls to hang masterworks on. And in much the same way, ETFs turn all of these transactions inside out. They make the transaction costs, those inner workings and the frictions, the problem of investors that are buying or selling, and they don't socialize them across all fund investors in the way that the mutual fund format tends to do. Now, having defined ETFs somewhat figuratively, let's define them comparatively, specifically versus mutual funds. And what we see is we stack up some of the key features of both ETFs and mutual funds. It's easy to see that they're really more similar than they are different. Both offer exposure to diversified baskets of securities, stocks, bonds, and other things. Both can be either index tracking or actively managed strategies. ETFs and mutual funds are just a vessel, they're just a package, as I mentioned before. So they're agnostic as to whether that's an active strategy, an indexed strategy, or something that sits somewhere between those two on this continuum of different types of strategies. ETFs offer more frequent portfolio disclosure than mutual funds in many cases, oftentimes as frequent as daily. While that's an interesting feature, I don't think many investors care to check on ETFs portfolios each and every day. What that feature really allows is for market makers to look into the contents of an ETF's portfolio so that they can price that ETF shares as accurately as possible when quoting two-sided markets in the open market during the course of the trading day, so that ETF trading costs are as low as possible. Premiums and discounts are infrequent and tiny. That information is really vital and an all-important input into market makers as they do their work each and every day. Intraday trading is another feature of ETFs that's often touted. I personally would argue that it's one that's oversold. I hope that most investors aren't trading their portfolios each and every day, and certainly not multiple times during the course of a given day. But what I would argue is even better than intraday trading is the sort of open access, the accessibility, the availability of ETFs relative to mutual funds that comes by virtue of being listed on an exchange like an individual stock. This means that any investor can invest in any ETF as long as they can pipe into the markets, as long as they've got brokerage, and invest in an amount as low as a single share, if not even smaller in the case of some platforms, some digital advice solutions. I would argue that that's really a truly important development, a very democratizing force that ETFs have had on investing more broadly for investors of all sizes. The other distinguishing features of the ETF wrapper relative to the funds wrapper have to do with their equity-like characteristics, everything related to the ET, or exchange traded, an exchange traded fund. And that's the fact that ETFs, like stocks, can be sold short, and many ETFs have very liquid, very robust options chains associated with them as well. So many investors that have a long position in a particular ETF will regularly sell covered calls against that ETF to generate additional income on that position. So the ETF wrapper in general is just simply more flexible, more transparent than a traditional fund. But what I would argue is that we've arrived at a moment now where choosing between ETFs and open-ended mutual funds is really boiling down to a matter of preference and circumstances. And I think considerations of tax are really what's driven a wedge here. And at the margin, we see more and more investors investing more and more of their taxable money in ETFs over open-ended mutual funds for all the reasons I described before. Now, it's also important to understand what ETFs are not. Now, ETFs are a relative newcomer in the grand scheme of things to the investment landscape. The first ETF was launched in 1991 in Canada. The first ETF was launched in the US in 1993. So despite the fact that ETFs are nearly 3 decades old, there's still a lot of mudslinging that happens in the financial press. And a lot of that mud is being slung by incumbents who really have no answer for ETFs. ETFs have been drinking their milkshake now for decades, stealing market share from them and attracting new investors for all of the reasons I've described and more, which I will describe. So it's important to understand that despite what you might see in the headlines, ETFs are not weapons of mass destruction. Virtually every sound analysis of ETFs' effect on capital markets and their functioning shows that if anything, at the margin, they've created safety release valves in capital markets. They've created greater price transparency. They've created greater liquidity. They've organized liquidity in the case of fixed income markets, and are far from being weapons of mass destruction, some sort of newfangled instrument that will bring global markets to their knees. I would also argue that this is not the first time that we've seen the incumbents within the asset management and the investment industry fret over the new kids on the block. What I feature here is actually an excerpt from the first chapter of John Brooks' book, Business Adventures. And the first chapter of the book really centers around the go-go years of the 1960s and the emergence of a new class of investors who was accessing at the time markets through what was a relatively new wrapper, which was the mutual fund situation. And this quote unquote mutual fund situation, in the mind of one expert at the time, one broker, was, quote, so terrifying that you didn't even mention the subject. Now, the incumbents, this broker in particular, were worried that all of these newly minted retail investors that were investing in the markets through open-ended mutual funds would all go running for the exits at the slightest signs of stress in the market. Now, in the ex-post analysis, when the go-go years came to a strong stop, was that it was actually professional investors who were the ones that flocked for the exits, and the SEC found that newly minted retail investors were happy to sit tight and keep their money parked in their newly invested open-ended mutual funds. So again, ETFs are not anything new. The allegations against ETFs, ranging from being weapons of mass destruction to indexing being worse than socialism, these are not new allegations. These have been a feature of the investment landscape for quite some time. So having defined ETFs at length, let's talk a little bit more about why investors might consider ETFs. And I would argue the key elements of ETFs' appeal really boil down to lower costs, superior tax efficiency, relative predictability, which is a term I borrow from the late John Bogle, and as I had mentioned before, access and flexibility. So costs matter, fees matter, implicit costs matter, turnover costs matter. What we found is that in all of the research that we've done, that we've seen that others have done, there's no more reliable predictor of future fund performance than expense ratios. Lower fee funds have a lower bar to jump over and tend to jump over that bar with greater frequency than their peers that charge relatively higher fees. It's just simply the arithmetic of active management, as William Sharpe put it. And picking good managers is hard. Discretionary active managers have an unenviable job of waking up every morning and having to try to outguess or outlast the market. So what we have here is really the seminal exhibit from our semi-annual Morningstar Active Passive Barometer report, which looks at the performance of actively managed funds versus a composite of their index peers. And what we find is that over a long period of time, most active funds fail to survive or fail to survive and outperform their average indexed peers. So what this table shows is the success rates, so the portion of active funds in any given Morningstar category that both survive and outperform their average active peer over any given period. And what you see is that across most categories, especially across longer periods of time, a tiny minority of actively managed funds are able to succeed for investors. Now, the far right-hand columns of this table show a sort based on the fees that these funds charge, the active funds. And what we see is that green shading indicates that the lowest cost funds across any given Morningstar category had above average odds relative to a random draw of active managers from that category of succeeding, and certainly relative to their higher cost peers, which uniformly in this case, and in this snapshot, had below average odds of succeeding over that 10-year look back period. The point being that fees matter. Tax efficiency, which I described at length before, is another key benefit of the ETF wrapper. And this is an exhibit from an in-depth study we did a number of years back, looking specifically at the difference between average capital gains distributions as measured as a percentage of net asset values between different combinations of active and passive, open-ended and ETF. And what we see in the second column from the left, the second column from the categories, is that the difference is absolutely massive between average capital gains distributions when looking at active open-end funds and passively managed ETFs. Those tax savings in many cases can even more than offset any alpha that an active manager may generate over any particular period of time. Relative predictability is a notion that really applies exclusively to index funds. This is a concept I'm borrowing from the late Jack Bogle. And with indexing, investors' expectations are crystal clear. They know they're going to get their fair share of the market's return, less a reasonable fee if the index fund is even charging a fee at all. And what we've seen over time is that relative predictability, taking out the unknowns, tends to lend itself to better behavior. Investors are more likely to stick with funds when they know what to expect from that fund at any given point in the market cycle. I want to expand a little bit on something I touched on before, which is that ETF liquidity is, in my opinion, wildly overrated, and that it's somewhat misframed. I think the ability to access ETFs through brokerage by virtue of trading them on an exchange is immensely underrated, because virtually anybody can do it. Virtually anybody can do it with small dollar amounts and access very low cost, very broadly diversified, very sound portfolios in a way that they couldn't for quite some time. So I would also argue that ETF liquidity is overrated because investors can do themselves more harm than good if they're trading their portfolios too frequently. I think it's important to really emphasize too that the ET in ETF, and that investors should understand and respect what that ET stands for, which is the fact that unlike mutual funds, which you drop a ticket for and you will get execution at NAV at the end of the day, you have to trade ETFs like stocks. So when it comes to good hygiene, kind of the wash your hands, cover your face, of ETF trading, if there were 3 words that I could share, and only 3 words, it would be to use limit orders, to name the price that you want, to ensure that you will get that price or better when your trade is filled. That, I think, is the single most important best practice, especially for more thinly traded ETFs, because there are people out there lurking that are looking to give you a fill at a price that will be to their advantage and to your detriment. So use limit orders when trading ETFs is the best piece of advice that I could provide. So finally, I'm going to speed through a few of our favorites so that we've got a few minutes left at the end for questions from the audience, and begin with just 3 plain vanilla funds that are perfectly suitable building blocks for a very simple, very straightforward 3-fund portfolio, offering access to US stocks, international stocks, and US investment grade bonds. This is a trio of Vanguard ETFs, all of which we rate very highly. They carry a Morningstar analyst rating of gold, which is our highest conviction forward-looking rating. And they carry gold ratings because they're very broadly diversified. Their fees are next to nothing. BND's fee now has to be expressed in apologies. I've gotten that figure wrong. Should be 0.035% but it has to be expressed to 3 decimal places. So you're paying next to nothing for a globally diversified portfolio that owns most securities under the sun, save for really international bonds and maybe munis in this instance. And you can combine those in an asset allocation portfolio as you see fit. All 3 are backed by Vanguard, which is really has been for decades at, pun intended, the vanguard of indexing, and has done a lot of good and made a lot of money for investors over the years. For investors looking for income, here's a trio of our favorite dividend ETFs. Now, each of these take different approaches to selecting dividend stocks from the broader US market, but what the first 2 really do is they emphasize dividend durability and dividend quality. They look for stocks that have paid dividends for at least 10 years in the case of SCHD, that have grown dividends for at least 10 years in the case of VIG, and they apply some additional filters to try to weed out any dividends that might be at risk within that selection universe. Both these funds, VIG and SCHD, charge rock bottom fees, 6 basis points, $6 on $10,000 invested in any given year, and are backed by really sound stewards, again, in Schwab and in Vanguard. Vanguard High Dividend Yield ETF is an interesting option because it strikes a balance between current dividend income and dividend growth. And it does so by sweeping in the highest yielding half of US stocks and weighting them by market capitalization. And what that market capitalization weighting does is it really puts the most money in the biggest, the most solid franchises. So it results in a really interesting and elegant balance between current dividend income as well as dividend growth. And again, charges a very slim fee for the privilege. Now, if we look further afield, here's another trio that I think are worth having on your radar. The first is the PIMCO Enhanced Short Maturity Active ETF, MINT. This is an actively managed strategy applied by Jerome Schneider and team at PIMCO, who have had tons of success over the years in this space. This is a strategy that at the margin, many are looking to as a substitute for cash when yields are paltry at best, so negative in real terms. It's an area where we've seen more and more investors parking their cash for short periods of time. EEMV, so the iShares Edge MSCI Minimum Volatility Emerging Markets ETF, say that 5 times fast, gets a Morningstar analyst rating of silver. We like this fund's approach to investing in emerging markets, getting exposure to that asset class while keeping a lid on volatility. So this portfolio tends to be about 20% less volatile than just a broad-based emerging markets index fund. It tends to favor some more defensive sectors within emerging markets, and it charges a low fee to boot. It's a fund that we've liked for a while now. And then lastly, for the more intrepid among you that are looking to take a contrarian approach within US stocks, where we've seen small cap value stocks make a bit of a comeback, lose a bit of esteem, but certainly have been beaten down for quite some time. The Vanguard Small Cap Value ETF, the ticker being VBR, gets a Morningstar analyst rating of gold, and that's really based on a combination of broad diversification, a low fee, and the backing of a very responsible steward in Vanguard as the parent firm for this fund. So with that, we've got just a couple of minutes left. I want to see maybe if we could field a question or two before I have to bid you adieu.
Hey, Ben, excellent presentation. Can you hear me okay?
I can, loud and clear.
Excellent. We've got about 2 minutes. One of our viewers write in, would you recommend VTI, VXUS, or BND? I'm not sure if you're familiar with those tickers, but do you recommend dollar cost averaging?
Yeah, I mean, it really depends on the investor in question and what you're trying to achieve. So, most of the research that's been done that looks at dollar cost averaging shows that especially if you have a longer time horizon, an immediate lump sum investment is probably mathematically a better bet than dollar cost averaging, though certainly from a behavioral perspective, dollar cost averaging might help you to minimize some degree of regret if you 3 years later find that you put that lump sum in all at one time and the market subsequently took a turn south. So I think it really, the right answer is going to depend on an investor by or vary on an investor by investor basis. People might have the Vulcan-like discipline to digest that math and plunk all the money down at one time, knowing that it's going to be invested for 30 years and they'll be better off. Others might want to take a more measured toe in the water approach.
Excellent. Let's see if we've got time for one more. Unfortunately, it looks like we're right out of time. Ben, I want to thank you so much for joining us today. A fantastic presentation as usual, super helpful for our audience. The 101s on ETFs. It's always a pleasure to have you, and we really appreciate your time.
Thanks so much for having me. Thanks,
All right.
everyone.
Thanks so much, Ben. Be well.